Okay, let's start our fourth class. And great. Last time we talked about trading strategies and what is a trading strategy. Today we will start with the same material from the previous class. It would be just a reminder, and so then we will turn to practice. We will have an opportunity to build our own trading strategies, to generate ideas how we can build a trading strategy, and we will test our trading strategies, how we can test them on historical data. So this is the reminder from the previous class. A trading strategy, this is a sequence of steps how we make decisions about buying or selling stocks. And we know that there are four components of the trading strategy. And actually this is the exact slide from the previous class. And there is one slight change in this slide which I would like to make. Last time we had, on the second step, we had when to buy, and on the third step we had when to sell. Actually now I changed that to when to open a position and when to close that position. Why? Because we remember that there are two ways how we can open positions. There are actually two types of positions. We can open short positions and we can open long positions. What is the process? When we think that we can make predictions and we can think that a certain stock will grow during a certain period of time, or we can predict that it will decrease. If we think that a certain stock will be increasing, in this case we buy that stock now and then we sell that stock on a higher price later. If we think that a certain stock will decrease in future, in this case we open a short position. What is a short position? It's a process when we borrow some stocks now and sell them. And then, after a certain period of time, we buy those stocks and return them. And in this case, it would be better to say that on the second step we have when to open a position. It can be either short position or long position. And on the third step we close it. So it means that on the second step we can either buy stocks if it is about a long position, or it can be selling stocks if we are talking about short positions. This is a slight change, but all other points, all other steps are the same. So today we will be trying to create trading strategies. That is why I would like to remind you what are the components of the trading strategy, and please maybe write down those steps, or remember them just in order to remember them when we will turn to the practice session. The first step, it's about what to buy or what to sell. Here we make a list of stocks which we would like to use in our trading. And general recommendations are to select stocks, select companies from different industries, and get some maybe latest information, latest news, or maybe some general information about the company, just to understand that it will not go bankrupt tomorrow. Okay. The second part of the trading strategy, it's about when we open a position. It means that we should have some criteria which tell us when we should open a position. Advice for today: when you will be creating your trading strategy, try to write down this criteria in math, using math. They should be strict. I mean, they shouldn't be like, okay, if now we have a very high price, we sell. If now it is a low price, we buy. This is not an exact formula. we would like to get something like if the price for Sberbank stocks goes under 60, we buy. If it goes over 90, we sell. Something like that. So that it will be able, you will be able to test your strategy on historical data. Because when you see historical data, and when you use historical data to test your strategy, the main problem is that you see the chart from, let's say, a year ago till today, and when you see a chart, you can guess when you can buy, when you can sell, and what would be the profit. And actually, if you know what will be in future, you can get infinite profit. But still, you should have some determined criteria so that you will be able to write some formulas or maybe write some code later on today to test your strategy on a large array of prices. Okay. And the third part is about when to close positions. It's also about some criteria, and those criteria should also be strict, should be defined strictly. And about money management, it's the way you distribute money across different stocks. So the general advice is to put to avoid putting all your money in one stock. Okay, and now I would like to show you an example of a trading strategy. So fortunately, I got some feedback from the feedback form of the previous class, and I understood that I didn't give an example, a concrete example about a trading strategy. And an example of a trading strategy will consist of 4 parts. First, let's start with the first part. It's what to buy. Here we can create a strategy for people with low risk. And in this case, we would like to select blue chip stocks. For example, Apple, or we can make a list of, for example, 10 stocks like Apple, Google, etc., General Motors. The next step. And in your trading strategy, this list should be determined. I mean, it should be like a list of company names. Here I just gave one example. We can enumerate some more examples. The second part, when to open a position. We talked about technical analysis, and I mentioned a strategy when we have a trading session which lasts from 10 a.m. till approximately 7 p.m. on Moscow Stock Exchange. It's approximately the same on foreign markets. On Nasdaq, it lasts from 9:30 a.m. till 4 p.m. But still, a trading session is something like a period of 9 or 10 hours. And one of the ideas is to trade during last, let's say, 15 minutes or 20 minutes or something like that. Why would we like to use such an idea? Because usually there are a lot of traders who would like to fix their profits, to close their positions by the end of the day. So they would like to get some results from the trading. For example, maybe they start trading at the beginning of the day, and so then by the end of the trading session, by the end of the day, when they will go to sleep, they would like to know that, okay, today I earned, let's say, $100 to $1,000, and I would like to go to bed knowing that all my money now in cash, so that no, let's say, no event which usually happen during the night or during the next morning will influence my positions. So the idea is that some traders close their positions at the end of the day. What does it mean? It means that if, for example, the stock, the price of a certain stock was growing during the day, maybe at the end of the day, people who bought that stock at the beginning of the day will sell those stocks at the end of the day. And usually it happens during last, let's say, 5 minutes or 10 minutes or 15 minutes, it depends. And the idea is just to catch such situations, to catch such events. And that is why, and one more point. Let's say that they would like to fix their profits. In this case, I have a question for you. What do you think? What would be under this assumption that traders fix their profits during the last 15 minutes of the trading session? What would be the trend for the last 15 minutes of the trading session? Increasing or decreasing? Decreasing. Yes, decreasing. In this case, what position would be open? A long position or a short position?
More than 15 minutes.
Long. In this case, we'll open short positions. And just to some disambiguation, long position and short position, this is not about time. It's not about time. It's about buying and selling. In long position, we first buy and then sell, and we use that when the price is increasing. When we open a short position, this is about a decreasing trend. So first we sell some stocks, we borrow and sell some stocks, then we buy some stocks and just return them. So in this case, the trend, under this assumption, the trend for the last 15 minutes will be a decreasing trend. In this case, we will need to open short positions, if you'd like to use this assumption. So, as the second part of the trading strategy, we have this sentence. We open positions 15 minutes before the end of a trading session, every day. When we close the position, we close the position, let's say, before the end of the trading session, let's say 5 seconds or 10 seconds. I put here 1 minute before the end of the trading session because sometimes, the process of filling the form of the order and pressing a button, submitting the order to the stock exchange, it takes some time. That is why I put just 1 minute. But if you are an experienced person, you can sell stocks or you can close positions, let's say 10 or 15 seconds before the end of the trading session. Yes?
But isn't it very obvious that you should do that, and all of the traders could buy before 15 minutes and sell prior 1 minute to the end, and that will just ruin the strategy?
Yes, this is a good point. So now we are talking about an example of a trading strategy, and trading strategies can be profitable or not profitable. I mean that now, let's say, it is very difficult to come up with an idea that, okay, I know that this, let's say, will buy stocks half an hour before the end of the trading session, sell them 1 minute before the end of the trading session, and this, I'm sure that this strategy is profitable. I will get 100% every year of profit. It's a very, let's say, rare situation. That is why we need to, first we need to test assumptions. And we try to create some strategies, then we test those strategies on historical data. After that we see that this strategy is not profitable, or is profitable or is not profitable. That is why we are going step by step. So first we need to create a strategy, then we will test that strategy.
So we are not talking about the profitable strategy right now.
We would like to develop a profitable strategy. That is why we try to generate ideas how to create a profitable strategy. But now we do not know, and Actually, no one knows about this strategy a lot. That is why we will test this strategy using historical data later on. But first of all, we need to create a trading strategy. Before testing a strategy, we need to create it. And the strategy consists of 4 components, and we need to specify each of these components. And we just think we have an idea that, okay, this strategy will work. And one more point. We will see that during the testing process of when we will test our strategy. But the main idea of trading strategies is that you won't find a strategy which will be always profitable. I mean, every day. It is enough to create a trading strategy which will give you profit during, let's say, a year or 2 years, and which will be profitable in, let's say, 60 or 70% of cases of different situations, 60% to 70% of days. Okay, what's next? We close our short positions 1 minute before the end of the trading session. So, for example, we take Apple stocks 15 minutes, strictly 15 minutes before the end of the trading session. We sell 100 stocks of Apple. And 1 minute before the end of the trading session, we buy 100 stocks of Apple. This is the trading strategy. And as for money management, we can assume that we do not put more than 5% of total money in one stock. We can agree, for example, that we put just 5% of our overall sum of money into one stock. So, yes, it depends on the money you have, but actually it can be 5%. If you have 1,000,000 rubles, we'll put approximately 50,000 rubles into one position. And in this case, yeah, we can calculate how many stocks we'll be able to buy. This is an example of the trading strategy. Okay, does anyone have any questions about the example of the trading strategy? Is this example clear? Okay, so by the end of today, you should create the result of today's practice session should be a trading strategy defined like this. So you should define 4 components of a trading strategy. What to buy, the list of stocks. When you open your position, strict criteria. When you close your position, this is even more strict criteria. And how you distribute your money. For the purposes of today's practice session, you can skip the 4th step of these 4 components. You can use just these 3 components, because the 4th component, money management, it's about risks and the way you manage risks. Okay. And now we will start to try to build our trading strategies. How we can build a trading strategy? Actually, this is not, let's say, exact science. It's about advice which I can give you about creating your own trading strategy. I advise you to do this in 3 steps. The first step is about selecting a trading approach. During the 2nd class, I gave you some advice that you should select one trading approach, either fundamental or technical analysis, and then try to study some techniques, or one technique within those approaches. And here, so first step of my advice is to select approach. First of all, either fundamental approach or technical analysis, and then within that approach, my advice for you is to select one technique. For example, trading with trends, using moving averages, using price to earnings ratio, or something else. So first you need to select what technique you will use for trading, how you will try to earn money with what technique. Then you need to make some guesses. Here I wrote make a guess, but actually it is better to make several different guesses because okay, one guess out of 100 different guesses and different techniques and strategies, maybe one or two will be profitable, will be good profitable strategies. Okay, then you need to generate some ideas or guesses about how that strategy can be profitable. As for the previous example, we made a guess that traders fix their profits and close positions during the last 15 minutes of the trading session. That was our guess. Maybe this is right, maybe this is wrong. We will test it later. And then we will, after you made a guess, you need to test that guess or that strategy on historical data. So it means that you make a guess and then you develop a strategy, you specify some criteria which I showed you on the previous slide, when to open a position, when to close that position, and then you test this strategy on historical data. Okay. Is this process clear to everyone? Because you will use it today. Okay, so just 3 steps. The first one, first you select a technique, then you make a guess and define a strategy, and let's say write a strategy based on that guess, then you test it on historical data. And if, so this is, you can use several iterations here. So you can make a guess, then you can test it, then you see that that guess was wrong, then you can go back to the second step and repeat these 2 steps until you have a good strategy. Or maybe you can come back to the first step and then change your trading approach, the trading approach you use, and then you will find a good trading strategy. Okay, so for example, what can be an example of changing guesses or changing assumptions? Let's say that we try to test a strategy when we open positions during the last 15 minutes of the trading session. Let's say we tested that strategy and it turned out that it is not profitable and the assumption is wrong. Maybe we can test a strategy when we open positions not 15 minutes before the end, maybe 20 minutes before the end of the trading session, or maybe 10 minutes, or maybe 5 minutes. And we can generate a lot of different assumptions between these 2 steps, and we can iterate through these steps. And we can test different strategies, maybe 5 minutes before the end, 15 minutes before the end, 20 minutes before the end, etc., etc. So this is not an easy process. And about the step number 3. This step, it's about testing your strategy on historical data. As I've said before, it is important that you should have your strategy clearly defined, especially component number 2 and component number 3, when to open a position and when to close that position, in order to test your strategy on historical data. Because historical data, usually it's a very long spreadsheet with a lot of different prices, and you should have a mathematical formula how you can easily test your strategy. Okay, as for these 3 steps, we'll use these 3 steps today. So for the first step, you know approaches. We covered approaches, trading approaches during the second class. About guesses, this is up to you. About writing a trading strategy, that we covered during the previous class, the components. About historical data. where you can find historical data. We can find it on the internet and almost everywhere. First of all, there are different websites of search engines like Yahoo and Google. They have Yahoo Finance and Google Finance, and you can go to, for example, Google Finance. Today, during the practice session, we'll use Google Finance to download prices. You can go to Google Finance, you can enter the company name or the ticker of that company, and you will be able to see and download stocks and download stock prices. More than that, you can see at these websites, you can see not just prices, you can see a lot of financial information, because when we select approach, we can choose not necessarily technical analysis, we can choose fundamental analysis. For example, price to earnings ratio, and in this case we'll need some financial information. So at these websites usually you can get not only prices, you can get also news, financial statements. Even on Google Finance you can see companies' management and companies in the similar industry, in the same industry, similar companies. Okay, and now it's time for demo. I think I will take some questions about trading strategies and the process. I want to be sure that everyone understands what is a trading strategy and what is the process of creating a trading strategy. Okay, maybe any questions about that?
Okay, about the first point, about choosing the stocks I want to do with. I have found a piece that I personally like. It's the high volatility stocks like CD systems, like some stocks on the stack, for example, that show that showed the downfall in, for example, half a year ago or like that, and shows the sustainable trend of growth in last month. What do you think about such approach, or do you think that it needs better?
Okay, this is up to you. So. This is a part of the trading strategy?
Yes, it's the first item.
The first part, yes. So you need to come up, based on that first part, you need to come up with 3 more parts of the trading strategy, then you can test that strategy. Mm-hmm. Right now, if you specify just one component of the trading strategy, it is very hard to say whether this is a good or bad trading strategy.
Okay. The first stage is a part, so everything should be considered together. So if
yes.
I have one point, I should fill with the others and test.
Yeah, so my advice is to specify 4 components of a trading strategy, then to test it on historical data. Maybe, okay, I'm not pretending that everything I'm talking here is 1% is always right. Maybe you can come up with a strategy which is not profitable on historical data, but will be profitable during next year.
Okay,
it can be so. But let's say that for the beginning, my advice for you is to test all your strategies on historical data.
Oh, another question about testing. For example, I have a strategy, so I should test within a certain window. So I analyze some data and I will make decision for certain date. Then I make the decision for next date, etc. How big should be that window and how?
I will talk about that during the demo part. Okay. So usually, you know, when you remember statistics, you need a certain number of experiments to decide that this is not just a coincidence. This is, let's say, correlation or something like that. And in this case, my advice for you is to take at least 100, let's say, days or weeks or minutes. It depends on your strategy or the period of your strategy. If you are trading day by day, my advice for you is to take at least 100 different days. If you are trading minute by minute, at least 100 minutes. But okay, for many companies, it is possible to download stock prices for last 10 years. In this case, you'll get data for more than 3,000 different days. In this case, you can just test on large area of data. The larger is the area of data use, is better. Okay, in this case, let's have a 5-minute break. And during this break, please go to Stellar, to the...
It is now down. It is under maintenance. It's 7 a.m. in the US.
Okay. In this case, during this 5-minute break, I will put a link. I will put a link to the screen. Sorry. Okay. I will put a link to a file, and your task is during those 5 minutes to download that file. This is a spreadsheet which contains information about demo. So now I will show you how we can build trading strategies and how we can analyze those trading strategies on historical data. And for these purposes, it's better to have a spreadsheet not only on the screen, but on your laptops in order to see the whole picture. Okay, and now it's... please come back in 5 minutes. It will be 4:51 according to my iPad. Okay, let's continue our class. So this is the link to a spreadsheet. Who succeeded in downloading this spreadsheet?
Downloading?
Who didn't succeed? Who has any problems with downloading this spreadsheet? Okay. And that was a very large spreadsheet. And now I will show. Now I will show you how you can get such a spreadsheet. I mean, what is the whole process? So now you downloaded the result of some result of analysis, and I will tell you what is the result and what was a profitable trading strategy which I built based on that spreadsheet. Now I will show you how you can get that spreadsheet from scratch. Okay. So for that we will need a browser. Okay.
Yeah, he grew too much. Yeah, he was used to doing
Sorry? The link, okay.
Можно нажать invite, ссылку. Ну нет, если что, и сюда нажать сколько фана и матч. Да, можно сделать что position.
This is the link. Okay. So who doesn't have a spreadsheet? Okay. Now I will show you how you can get a lot of spreadsheets and how you can analyze data. First of all, let's say that you remember that that building of a trading strategy, it consists of that a trading strategy consists of 4 components. And the first component, it's about selecting stocks which you will buy and sell. in this case, we need to make a decision, and this decision may depend on different parameters. But
Can you repeat one more time, Sasha?
repeat what?
What you said. Okay, the first thing that you
The strategy is
We are going, we are creating our own trading strategy, and the first component is selecting which stocks we will buy and sell. And let's say for now that we decide to use Apple stocks because Apple it's the largest company in the world, and it is stable, it is profitable, etc., etc. And we decided to use Apple. In this case, we go to Google Finance website. And as for technique, we are going to use, let's say that we would like to use moving averages as a technique for our trading strategy. That was also our choice. Okay, we went to Google Finance website and we entered Google, and there is a panel on the left, and you can see historical prices. Let's press historical prices. Now we took moving averages approach, and if, for example, if we take fundamental analysis, in this case we would investigate this part about financials, about revenue, profit, etc., etc., etc. But for technical analysis, we need to get historical prices. And here we press historical prices. We can see the prices for Google stocks in the past, for January 21st, for January 20th, etc., etc. We would like to get these prices, to download them. On the right, there is a button or a link, download to spreadsheet. We press that button. And now we have a CSV file. Which is not actually so beautiful. Okay, now we have a CSV file. If you have actually you have to somehow to change settings of your Excel file so that it can be able to parse commas and dots. In the settings of this version of Microsoft Excel, something is not good. That is why we will come back to my Microsoft Excel. But okay, I hope that now everyone understands where we can find a spreadsheet with the historical data and how we can download it for a certain company. Now,
Sasha, may I ask a question? So
yes.
this was from NASDAQ, and you can find historical data for any stock markets. Like
yes.
Moscow,
Yes.
Sberbank, right?
Yes. For Moscow Stock Exchange, you can also find a lot of data. The easiest way is to go to finam.ru website. But unfortunately, it's in Russian, so if you would like to get some data in English, I think you should just Google or go maybe to the website of Moscow Stock Exchange.
So Google also, I mean, like, as a
Yes.
search tool.
Yes, but Google Finance also provides some data about all the companies which are present on large stock exchanges. For example, Moscow Stock Exchange. We could have taken Sberbank or Gazprom and also see prices of all those companies. Okay, and now, okay, now we have such a spreadsheet. And when we downloaded it, we had these columns. So these columns, we took them from just that spreadsheet from Google Finance website. Is this clear?
Yeah.
So historical data usually consists of several parts, several columns. First of all, it's date. So this is a spreadsheet where we got some information about day prices. So each row stands for a certain date. For example, January 7th, and this row stands for that date. We can see several columns. First column is open price. What is an open price? Open price, it's the price which took place at the beginning of the trading session. So so for example, if the trading session starts at 10 a.m., this is the price for 10 a.m. The next column, it's about the high. It is called high. This is the highest price for that stock, which took place during the day or during the time period. Low price, the same idea with low price. And close price. The close price, it's the stock price for the last, let's say, last tick of the trading session, or last second. Volume, this is the number of stocks which was sold and bought during the trading session. Let's say, for now we'll forget about some of these columns, for example about volume. This is an important column, but we will base our analysis on other columns. First of all, we can calculate some figures. For example, day change. What is a day change? Day change, this is the difference between the close price and the open price. How we can calculate the day change? Actually, this is a very simple formula. This is the change. Sorry, this is I mean, not the difference between the close price and the open price, but the difference between close price of today and the close price of the previous day. So this is the change which took place during 24 hours. Okay. So at, let's say, 7 p.m. Yesterday, the price was $100. At 7 p.m. Today, the price is 110. So the day change is equal to $10.
Why it's evening? Why it's not morning price, like opening price?
Sorry, what price?
I mean, daily change. It's different between evening. I mean, between
close prices.
Why
yes. Okay. This is just my assumption. You can calculate the difference between open prices, and so the general idea behind this analysis. Now we have a lot of data, and we can somehow try to analyze this data. I'm showing you just one of the ways how we can analyze this data. You can use a lot of them, and during the practice session you will be able to use whatever technique you want. That was just my approach.
So
and
it's close in price minus goals in -1.
Yeah. So. Okay. So if you have the same spreadsheet, so you can see all formulas inside the spreadsheet. This is the daily change. Okay, we can calculate it as a change from close price to the previous close price, or as open price versus the previous open price. But here we calculate it as the difference between close prices. What do we have next? Volatility. As for volatility, there are, let's say, different ways how we can estimate volatility, and actually maybe there is even a strict mathematical formula, but I prefer to use a very simple version of volatility, because usually they use dispersion or something like that. The difference which takes into account differences, fluctuations, etc. I just simply count the difference between the low price and the high price, and I call it volatility. Okay, this is my approach. You can use another approaches. This is just a decision, and actually we will not use this this term here. It's just an example.
Yes. Question. When you download it, you don't have this daily change in volatility. You calculate it those ones, right?
Yes, yes. As I said before, when I downloaded this data, I had only these columns. Now we are going to use moving averages. So we took moving averages as our technique we'll use in building this trading strategy. This is just an example. Assume that we take moving averages for our moving averages technique for building a trading strategy. In this case, we need to remember what is the definition of a moving average. This is the average price for the previous, let's say, 20 days. I took 20 days here. First, when I first tried to create a trading strategy for today, actually I started from 5-day moving average. And that was the process of iterations, of iterating through some steps. First I took 5-day moving average, then I took 10-day moving average, 30-day moving average, but those strategies were not profitable. So that's why I took 20-day moving average. That is why here we have 20-day moving average, because okay, that strategy turned out to be profitable on historical data. But for your analysis, you should understand that you can take 5-day moving average, 10-day moving average, then you will see that some of those strategies are profitable, some of them are not. Let's say we took 20-day moving average, and this is the formula. You see, this is just a sum divided by 20. The sum of 20 previous prices. The same for all other cells in this column. This is just also the price. And the good point about these calculations is that you can do everything automatically. So, for example, you put a formula into this cell, and for example, you would like to calculate not 20-day moving average, but let's say 10-day moving average. In this case, you just change some values in one cell, and you then you can do like that. I think you know this trick, and you will have everywhere 10-day moving averages, and this takes just 20 seconds. And now you have 10-day moving averages. Okay. What's next? Now we have moving averages. Remember that on the second class we were talking about trends and how we can use the concept of moving averages in trends. Here I just use a very simple approach. Let's say that we have a moving average, and if the current price is higher than the moving average, we think that this is an increasing trend, and in this case we buy that stock. If the current price is lower than the moving average, then we think that this is a decreasing trend, and okay, we sell that stock. This is a very simple approach, and I made here 2 more columns about hypothesis. So there are 2 possible situations. Then the current price is lower than the moving average, and then when the current price is higher than the moving average. In one case, we'll need to open a long position. In the other case, we'll need to open a short position. And so this is just a number of ones and zeros. to understand whether our hypothesis is right or wrong for one day. So this is, let's say, let's see the formula for this cell. This is the comparison of several cells. We compare the current moving average with the closing price of the previous day. So let's say that today is January 20th, and we know that the current price is equal to this, let's say, to this value. And we compare that price with the current moving average, 20-day moving average. And this is this comparison. And we see what was the daily change after that. So it was positive, and it means, what does it mean? We compare I2 cell, we compare, sorry, we compare J2 cell, which is the current moving average. You see here, this is the current moving average with the close price. And if the moving average is higher, then we open a long position. This is the definition of when we buy stocks. And we see that the daily change. If they have the same sign, then we put 1 here. This is, additionally, this is not a formula which you will be able to find in books. This is just my approach. And 1 means that the sign of, it means that the sign of the difference between the moving average and the price and the day change was right, was correct. It means that strategy worked for that day. Yes, please.
Why don't you take into consideration the amplitude of this daily change, just the sign?
I just took a simple approach. Okay, if we take into account other parameters, I will have to spend, let's say, 2 hours to explain that instead of 15 minutes. So, okay, this is just a very, very simple model, which I would like to show you how you can create a simple model. Then you can add to this model different parameters, different factors. So here, here, 1 means that our hypothesis works for that day. For the long position, that column stands for the same hypothesis for short positions. So it means that, okay, if it's equal to 1, it means that, let's say for this day it's equal to 1, it means that the strategy worked. We had, for the previous column, we had close equal to this value, we had moving average equal to this value, moving average was lower, we opened a short position, we should have opened a short position according to our strategy, and the daily change was negative. Okay, and we have a set of zeros and ones. This is just a flag for us to see whether a strategy is good or bad. And at the end of this spreadsheet, here you see this gap, just because we calculate 20-day moving average. If we do not have data for the previous days, for example, for this day, we can't calculate 20-day moving average because we do not have enough previous data. So we started from just this position. Okay, and we see that the sum equal to 38 and to 71. This is for long positions, this is for short positions. We can sum them and we will get 108, right? Oh, sorry, 109. Okay. And here we tested this hypothesis on 223 different days. It means that out of those, approximately in half of situations our strategy worked. In half of situations it didn't work. This is not so good for a real trading strategy, but still this is okay. Okay, now we see that we found a strategy which works in half of situations. We would like to understand whether it is profitable or not. We need to calculate the profitability if we used such a strategy. How we can do that? We assume that at the first day our money was equal to 1. Okay, this is an assumption. We can put 1 million, but for the sake of simplicity, we just put 1. This is the first day. Then, if we use our strategy, this number will be changing. And our strategy, I remind you our strategy, we compare a moving average with the close price, and we open short along either short or long position, depends on the sign, depends on that comparison. This is a large formula, which we'll try to understand right now. Here, for calculations, I just remind you about these two points. That column, the first column was about opening long positions. The second column was about opening short positions. So does everyone understand the difference between the columns? Okay. So this is about long positions, this is about short positions. We see that the numbers are not equal. This number, it's just 38, so it worked in 38 days. This worked for 71 days. What is the better column? The first or the second? So the second column is better for us because it worked for twice as many situations as the first one. Yes?
So, but definitely those commissions are not included.
Commissions are not included here. Yes, so this is a very good point. I didn't include commissions, broker commissions, because that would just, let's say, this will make a model a bit more complex. That is why I just, for now, eliminated all commissions,
So,
all broker commissions.
But the general question is that if we apply commissions for some of brokers for short positions, then will the number of success hypotheses for those will be dropped as twice?
It depends on your broker, but actually for most brokers, if you open a short position within a day, so here if you open a short position, we open it for within a day, or yeah, for 1 day. We can calculate that. It depends on the broker. So you just take a list of rates of your broker, you see the commission, and you include it into this spreadsheet. In most cases, the commission rate is not very high. That is why for, let's say, for preliminary calculations, you can just use them without commissions.
Wait a minute, you mean the situation when you take borrow money? When you have...
Yes.
Okay.
Yes. So, I mean all situations about deals, so you pay commission for each deal. So I do not, for each deal, for borrowed money, for something like that. Here I do not include these figures because these figures depend on your broker and your broker's commissions. And they will make the model more complex.
If you add the commission rate just at the end on the profit, it's not the same?
Sorry? Commission for profit?
If you include the commission on the final profit result,
no, no, because if you have profit of 10% per year, you can do that profit with one deal and you will pay commission for one deal, or you can do that with 1,000 deals. In this case, you will pay commissions for 1,000 deals, and okay, you see that total number of commissions depends on the number of deals.
Okay.
And maybe of the number of situations when you borrow money, open long position, short positions, it depends on your broker. Here, this is a very simple model. Okay, and we can decide that we will use only the, let's say, the second strategy with short positions. We understood that opening long positions works in only 38 days. This is not so good, but this strategy worked for 71 days. Okay, and we start to calculate the strategy. This is a very, let's say, a bit complicated formula. This is an if statement. So if we compare the moving average with the close price, and if it is higher, so we use this value. It means that if it was high, we do not open short positions. If it is low, we open short positions, and in this case, we calculate how much we could get according to this statement. So we calculate our result from the previous day, our cumulative result from the previous day, and we multiply that by this ratio. Okay. Now let's take, let's say, 15-minute break. So for now, I showed you this spreadsheet. You can see prices. You can see prices which we downloaded from the internet. You can see techniques which I used. Now you have, let's say, 15 minutes. This is for the break, and you can maybe see some figures, see the way they're calculated in this spreadsheet, and then come up with questions. And during the second part of the class, we will split into groups of from 3 to 5 people, and we will try to develop trading strategies. Okay. Let's continue in 15 minutes. Now we have approximately 1 hour and 10 minutes before the end of the class. Now I would like to give you time for practice. It means that we have discussed from the very beginning. We discussed on the first class how you can submit orders to the stock market. On the second class, we discussed common mistakes and some more stuff. On the then we discussed trading approaches and trading strategies. And finally, I showed you how you can create a trading strategy using a spreadsheet. Now, please make groups of maybe from 3 to 5 people and try to generate some ideas how you can build a trading strategy. So let's do this in this way. Now it's 5:50 p.m. Let's take approximately 20 minutes, and during these 20 minutes, please gather in groups and generate some ideas, so that you will be able to use them in your future trading strategies. It means for now that you do not need to create, let's say, a very concrete trading strategy, but you need to come up with at least several different ideas about how you can get some money on the stock market. Maybe you can write a trading strategy. This is not required. You will do that later on. But please come up with at least, let's say, maybe 3, 4, 5 different ideas how you can make money. Something like buy 15 minutes before, sell 1 minute before the end of the trading session. Is this clear? Yeah. Okay, so now it's 4:50. We will gather results. Each group will let's say, will tell us a few words about their trading ideas in 20 minutes at 5:10. Okay, let's continue our class. And now let's give each group maybe from 3 to 5 minutes to present their results, to make a maybe short presentation, maybe or short list of ideas with some explanations, explanation of how they think it is possible to make money, with what approach, with what technique. Which group wants to be the first?
We can start.
Yes.
We can just introduce. So basically, since we were short in time, we just can you all hear me? Okay, you're very sleepy. Anyway, we also consider, instead of only the sign of the magnitude of the daily change, also the magnitude. So what if it is 0.01 or 1.4 instead of only negative or positive. And so we made for the average of all the positive daily change and the average of all the negative daily change. And we upgraded the hypothesis 1.1 and 1.2. So together with comparing the positiveness of the daily change and the moving average, you also add if the same number is greater than the average of the positive, or in the negative case, the negative case, and then you reduce this way the position that you should open, the long one and the short one, and we have like 19 for the long one and 20 for the short one.
By 19 you mean 90% or 19 ones or what?
19 ones.
19 ones, okay. As for the this spreadsheet, it's about testing your strategy on historical data. So the most important number is located on the top right corner. So it is, I will show you. It is located in this corner. This is the most important number of this process. What does it mean? It means that we tested our strategy on historical data and we got approximately 3.5% of profit. So we started with 1 and ended up with 1.0349. Okay, and for your hypothesis about positive averages and negative averages, it's better to calculate this result, because actually none of these numbers actually matter. I mean, in terms of zeros and ones, all these numbers are just additional or something like intermediate numbers or preliminary numbers, and you need to calculate this number to understand whether your strategy is good or bad. If you see something which is greater than 1, this is a profitable strategy. If you see something which is higher than, let's say, 1.2, it is equal that you have a strategy which gets more than 20% on your on historical data, and yeah, this is good. You can compare this outcome with, let's say, an interest rate in banks. We know that you can put, you can open a deposit account in a bank. You can get approximately 15 or 20% in rubles for a year. This is these are numbers for 1 year, so you can compare the profit of your strategy with the profit of opening a bank account. Yes, please.
Should you calculate the percentage of going now and 1 is bigger than 1 or less than 1? I mean, the frequency of numbers is bigger than 1. Because, yeah, how would we test that our hypothesis is working?
Actually, the most important point, the most important number is the result itself. But we started not from that result, we started from 1, which was located on the bottom of the page.
Yeah, but I mean sometimes the number is less than 5%. We lose more than 5%.
If a number here is equal to something which is less than 1, it means that by a certain day you would lose sum of money. And for example, if this number equal to 0.97, it means that by that date, using that trading strategy, you will lose 3%.
Yeah, but what if mostly we just lose by this strategy and just sometimes we return some money?
Actually, this is good idea. I didn't think about it. Yeah. This is a good point, yes. So maybe at the same time, yes, it's a good idea to take into account, let's say, frequencies of profits and losses in this column. Yeah. So here we just tested a strategy. Here we are testing strategies on historical data. So here we assumed that we started on the 6th of March of 2014, and we finished on January 20th with this strategy. And in this case, we would have plus 4%, plus 3.5%. But we could have started before that date or after that date. In this case, yes, different periods of time can give you different periods of, can give you different results. The best way, let's say, a good idea would be to put these numbers on a chart, on a historical chart. I mean, you just take this column on the right, and you take this column on the left, and you build a chart, and you can see the changes in profitability. And if in most cases it was less than 1, in this case it's not, let's say, it can be positive during, the strategy can be profitable during 9 months, but it can be not profitable during 8 months or 7 months. In this case, it's better to avoid such strategy. So, the advice is to put these numbers on a chart.
Nice question.
Yes.
So it's a good way to put it on a chart, and if there is going to be a trend, so to use the strategy only during periods of profits, right?
But it is, yes, the best idea is to use a strategy when it is profitable. But you can see it only on historical data. You can't predict, for example, you can't determine whether today is a profitable day or not profitable day. Or whether tomorrow there will be a profitable day or not profitable day. So you do not know whether you should open a position or shouldn't. And you need to have some criteria how you determine that. And that is your strategy. So in this case, yeah. Let's go to the next group. So general idea of taking into account average values of profits and losses, it's a good idea, because sometimes you can, there are different examples. You can earn 10%, sometimes you can lose 10 times, 1% 10 times, and these are different situations. That is why, yes, it's better to predict such situations. It's one of the approaches. I don't know whether it's profitable or not. You need to take some historical data and calculate that number on the top right corner. Okay, let's go to the next group. Who would be the next? Yes, please.
So we define a company with a trend on the stock market. When we will choose the closing price and take a Fourier transform from its closing price, for example, for previous 30 days. After that, we will find which frequency is domain. And according to this frequency, we will open or close, will open long or short position according to the trend with this frequency.
Okay, yeah. This is a good approach. I think now you need to take some data, some historical data, and to take a company, to take historical data, and to find out some examples, some maybe concrete values of frequencies, and to calculate the profitability of the strategy during, let's say, 1 year or 4 years, whatever. This is so trends and calculating the duration of the trend and frequencies. This is a good idea. It is one of the ideas which is widely used in technical analysis. It actually depends on your decisions about frequencies, durations, etc. Okay. And what is the next step or next assignment? So now we're discussing ideas. Okay, guys in the back, please be quiet because we are on the stock trading course, and we have some stuff to cover before the end of the class. Okay, so now we are going team by team with some different ideas, techniques, and approaches. At the same time, we have this feedback form with this short link. So your task is to fill this feedback form. By the end of the class, so you have approximately 35 minutes, you need to develop a strategy, a trading strategy out of, let's say, your ideas and your techniques. If you open this form, you will see that it has fields for each of the components of a trading strategy. So you need to specify as you need to specify in details what is your trading strategy, and you should describe each component of the trading strategy as precise as you can. I mean that it shouldn't start with something like we take a company. It should start with we take Apple, and we take, so the first component, we are trading Apple stocks. And the second component, we buy them 15 minutes before the end of the trading session, or we buy them if the previous 30-day moving average is higher than the current price, or whatever. Then the third component and the fourth component. Now you can, in the fourth component, you can write, fourth component is not so necessary for today, but first three are necessary. So after you present your ideas to the class, you can go to this form and try to describe your trading strategy. Okay. Okay. Who wants to be the next to present the strategy? Okay. Who has developed any ideas, not strategy, but maybe ideas during the previous 20 minutes? Okay, in this case, now you have time to fill this feedback form with your trading strategy. And you should also write the profitability which you calculated for that trading strategy. So now you have approximately 30 minutes for practice. You can take your ideas which you generated during the previous 20 minutes. You should somehow put these ideas into numbers, into algorithms, into some specified criteria. Then you can take an Excel spreadsheet with prices, maybe for Apple, or you can download with other companies, and then you calculate the profitability of your strategy on historical data. And you need to fill these fields in the feedback form. Yes, and at the same time, I've heard from the education office that we have pass-fail system for the class, and just a clarification that you need to submit all feedback forms to have pass for this class. So this is required.
But you don't know the quote of submission yet?
Okay, empty forms. I mean, each form contains some required questions.
Yeah.
If it's a question, what, for example, what you disliked about the class, you can leave it empty or just put something to submit the form. But if this is a question about your training strategy and you are leaving all fields as empty or just with dots, I don't know, this not will count as an answer, as a field feedback form. So by field feedback form, I mean a feedback form where you put some answers to questions, not just anything which you submitted. Okay, yes?
Yeah, let me ask a question. Can we get the information about number of sellers and buyers, like historical data to analyze?
This is about volume.
So how does it count? Is it the minute or the day? Or?
It depends on the data which you would like to download. We download it day-by-day data. So in this case, if we have a row saying this is data for January 20th, it means that if volume is equal to 3 million, it means that during January 20th, 3 million stocks were bought and sold.
Yeah, but can we get this data separately? I mean, buyers and sellers, not like all people on the stock market or stock exchange.
What do you mean? You can get more, let's say, more detailed data minute by minute if you go to finam.io. There you'll be able to download data for minutes, for hours, even for ticks. But as for buyers and sellers, if, let's say, I'm not sure that you will be able to find data for orders which were not executed. You will find data only for executed orders, for successfully executed orders. It means that the number of buyers and sellers, I mean the number of bought and sold stocks will be the same. Just, yeah, because if one person sells 100 stocks, another one buys the same number. That is why they will be equal. So it is the same number. What's next? Yes, if you would like to get more detailed data for intraday trading, for trading within one day, you can go to finam.io and download some data from that place.
Yeah, and I also want to discuss our trading strategy. Like
Okay.
we have an idea to create a trend for the stock exchange, and I mean the trend for buyers or trend for sellers, and make like a correlation analysis or something to the price, and probably make predictions like when we can open short position or long position, and just following the trend of buyers and sellers, and not paying too much attention on the price, because we somehow can make a decision faster if we just look at this number, not the price.
You can try that. You will not get the number of buyers, you will get the volume. It means that if the volume equal to, let's say, 3 million stocks, it means that it can be one person who bought 3 million stocks, or it can be 10 people who bought 300,000 stocks, or it can be 3 million people, each of them bought one stock. And you will not get such kind of information, I think. You will get just 3 million. But still, all these websites provide information about volumes because this is sometimes an important piece of information. When there is some breaking news on the market, some important news, when such situation happens, when something unexpected occurs, you can see that the volumes are very high, are higher than average volumes. So you can compare, you can try to compare somehow the volume of the current day with the volume of, with the average volume of 30 previous days. In this case, you can see that if the current volume is twice larger than the average volume, it means that something happens on the market. And then you'll need to understand what happened, and could you see a trend, or maybe could you predict what will go next after that? You can take out volume, and this is a good idea. Actually, we considered a very simple model about using moving averages. Now, and you saw that for that simple model, for 1 year we got profitability of approximately 3.5%. This is a small number. It is less than 0 in terms of profitability, but it's a small number. To get a high number, you will need to introduce more complex conditions, statements, circumstances.
Yeah, and also about the total price and the average. If we just calculate an average, it doesn't give us the information about how the price actually changes during the day. But if you want to sell it and buy in the daytime, it's better probably to pay attention to low and high price, probably daily, make a gain trend, and compare to the average. And probably we can just sell it to the biggest price in a day.
You can take into account high price, but okay, during the day, imagine a situation before the day. So today is Thursday, and imagine that the current price for Sberbank is 60, and now it would be better. It would be difficult for you to understand whether now it's the highest price which will take place throughout the day, or maybe there will be a higher price during the day, and when to sell Sberbank.
Then I also don't understand why people sell their stocks in the end of the day.
It's just an assumption. Why? Because sometimes I would like to go to bed knowing that I have a certain sum of money in cash, and let's say, no events, no night events may occur in my portfolio. For example, in December there was a situation when the Central Bank of Russia increased the interest rate for commercial banks from 10.5% up to 17% at 1 a.m. at night. And as a trader, I would like to avoid such situations because, on the next day you can see that the prices for all your stocks fell dramatically.
Then at the first lecture you said that it's better to save the money on stocks, but rather than keep it in cash. I don't understand why people try to sell it at the end of the day, but not.
Because there are millions of traders and they have different strategies. Some people invest their money in stocks for months. In this case, they usually buy stocks and forget about them, and they will come back in 6 months and see the result. But there are a lot of intraday traders who would like to earn some money during a day, and they make, let's say, 5 or 10 deals, or maybe hundreds of deals every day. And for them, if they trade within a day, it is better to finish the day knowing that they got some profit. Because they submit orders, let's say, one every 10 minutes, something like that. And for them, 12-hour period, which takes place between the end of the trading session and the start of the next trading session, is very important, because they usually make deals within minutes. If you are investing your money for months, in this case, one night will not significantly influence your prices.
But the strategy that you showed us, like 15 minutes at the end of the day, when we can sell or buy something, is it just when you want to use the same, like trading in the daytime, or it's about long-term trading?
This is about trading in short term. And actually, this is the difference between technical analysis and fundamental analysis, which we covered during the second class. Fundamental analysis is more oriented on long-term investments, because we try to analyze the company's profits and revenue, each company publishes revenue once in a month or once in 3 months. And in this case, you try to predict the price for the stocks for, let's say, 3 months or 6 months. And this is fundamental analysis. If we are talking about technical analysis, they usually try to get profit during a day, during a week, during a month. And the periods of time are very different. And in our model, in our trading strategy, which I showed you, I said at the beginning that we are trying to use technical analysis, we are trying to use moving average approach. Moving average, it's about technical analysis, it's about trading maybe within a day, within a week, something like that. And I forgot to mention some more information about these trading strategies and feedback forms. As you remember, during each of the previous class, we had some questions and prizes for correct answers. Today we will have prizes for filling this form. But if you submit this form by tonight, I mean today, by 11:59 p.m. in this case, I will try to find. I will look through all your strategies. I will select some of them, and authors will get some prizes during the next class. Okay, and in this case, I would like to ask you to fill this form with your own trading strategy. It means that if you have a group of people who are working on the same strategy or on the same idea, please somehow differentiate your ideas, I mean your strategies. Maybe in the situation with 15 minutes before the end of the training session, one of you can take, let's say, 15 minutes, one of you can take 10 minutes, or maybe one of you can take 20 minutes, something like that. I would like each of you to be able to create a trading strategy, to define a trading strategy, and to calculate its profitability on historical data.